Hello everybody, it's Tortoise Investing coming at you today with 3 dividend stocks that you can buy and hold forever. If you're new, please hit the subscribe button, make sure to hit the like button, and drop a comment down below. All those things help the YouTube algorithm out, and let's grow the channel and our portfolios together. We're at 723 currently. Let's get that march toward 1,000 going. Let's go. Let's check out the portfolio first. This is my personal portfolio. I'm going to be completely transparent with you into up, downs, all arounds. Stick with me here. And we'll go to the whole. Well, we're up 17.16% year to date. And S&P is right at 14%. It is just took off like a rocket in the past week, like up almost 6%. So it's gained a little bit on us, but we're still beating it year to date. And the holdings tab, this is how we are looking now. Extra space storage, Hershey are our big losers, but that's okay. I like them both long term, and if they drop any more, I'm going to add more, but right now I am mainly focused on building up a little bit of a cash position. I'd like to have about 400 put back in case things were to just get hectic, like if MasterCard and Apple or something like that was to just drop through the bottom, I'd be able to pick up more of it, because those are the two positions I'd really love to add to. But yeah, that's how everything is looking with the portfolio. Now the stocks we're going to be taking a look at, we got Intuit, Automatic Data Processing, and the Hershey Company. You know I like Hershey. Starting off with Intuit. Intuit's got adjusted free cash flow yield of 2.2%, has a dividend yield of 0.72%, and a payout ratio of 37.28%. Now, you might be thinking, that's on a run this year. What are you doing? Well, if you look at the all-time over the last 5 years, this thing was up over $660 at one point. So, no, 684 it looks like it was at its peak. So, it's sitting at below 500, personal opinion. Always do your own research, not financial advice. It's not a bad entry point for it, especially if you believe in what they're doing long term. And it's Intuit. Like the TurboTax thing, like that alone is just moneymaker right there. Revenue's been increasing at a rate of 13% over the last 10 years. This is very nice, just up and to the right. The free cash flow, 15.26% over the last 10 years. Now, if this company, you do have a lot of stock-based comp, and that does chop into it a good little bit. But even adjusted, is this adjusted? Yep, adjusted per share from stock-based compensation, you're still right at 13%. On your free cash flow growth over a 10-year period. That's what this comes in. It looks like it chops into about 36%, but they're still growing their free cash flow quicker than they're increasing their stock-based comp. EPS been increasing at a rate of 11.5% over the last 10 years. Very nice. Their balance sheet's really nice. Their debt, they have $6 billion in debt. Their EBITDA is $4 billion, but they have a bunch of cash. They have $3.6 billion in cash. My general rule of thumb is I don't like companies that have more than 3 times their EBITDA in debt, because that's a little bit of a red flag for me when it comes to their balance sheets. Now, the dividend, 16.83% increase over the last 10 years. This is just a very nice set of stairs, and this is the definition of compounding. Love it. Now, the payout ratio, a little bit on the low side, but that's okay. They did have to issue out some more shares, it looks like, in 2022 and 2023, so that's probably what this is about. But besides that, I mean, it's still 13% is nothing to not brag about, because the market average is usually around 9 or 10. And with what they do, it's a very profitable business. Oh my goodness. Operating margins, 20% area. Profit margins, 16, 20s, usually where they're hovering, and their gross margin is above 70, 80%. So that is just, they know what they're doing. That's bonkers. That's Intuit. Next up, Automatic Data Processing. This one I've had my eyeball on, and I wouldn't mind to see it dip again so I could jump in. I didn't have the opportunity to get into it when it was below 210 at one point. I had to wait for payday. That's the reason I'd like to have that 400 put on the sideline just in case. Because if I had $400 and this was in the 200s, like low 200s, Absolutely. Just a free cash flow yield 3.35%. We got a dividend yield 2.29% and a payout ratio of 59.4%. Revenue slow and steady over the last 10 years, 4.68%, 5 years right at 6% growth. Does look like it is increasing slowly but surely, which is nice. Free cash flow has been increasing at a rate of 10.88% over the last 10 years. Double-digit cash flow growth. Very nice. When it comes to this company, not much with the stock-based compensation, so it's not going to mess with that too bad. EPS, 11% over the last 10 years. Again, it's up and to the right. Another company with a very attractive balance sheet. They have right at $3 billion in debt. Their EBITDA is $5.26 billion, so if they wanted to pay that off, they could easily. And they have cash on hand, over $2 billion in cash on hand. The dividend's been increasing at a rate of 12.59% over the last 10 years, and they've got some pretty big stairs in here as of late. Looks like over the last 2 years, the rate of right at 16%. So these last two hikes have been monstrous, which is, again, awesome. Compounding. Shares outstanding, we didn't look at that into it. That's just because they're kind of all over the place. They don't really do share buybacks all that much. But with ADP, they've been buying back shares at a rate of 1.57% over the last 10 years. A nice little trend downward. And return on capital employed is beautiful, 30s, 40s, and even above 50% this year. So that is very nice, very nice. They are using their money very, very wisely. Now, next up, we got Hershey. I like Hershey. Hershey's down from its recent high of over 270 down 188. I have been adding on my way down. Adjusted free cash flow of 4.14%, got a dividend yield of 2.54%, and a payout ratio of 46.29%. Revenue slow and steady, 4.6% over the last 10 years, but that is increasing, 6.75% over the last 5 years. Their free cash flow has been increasing at a rate of 8.27% over the last 10 years. Over the last 5 years, 12.26%. So again, it is increasing. You're getting that double-digit cash flow growth. EPS increasing at a rate of 10.61% over the last 10 years. Very nice. Again, all of these are pretty much double-digit growers in all their categories. The debt is $3 billion. Their EBITDA is $2 billion. Again, beautiful balance sheet. Nothing really to worry about there, and they do have some cash on hand. And the dividends have increased at a rate of 9.39% over the last 10 years. And their last two hikes right at 15%. So if you can see here, these are pretty big steps. They've been increasing their dividend a little bit quicker. Very nice. Again, compounding. Love to see it. Shares outstanding right at 1% over the last 10 years. Looks like here lately they've not really been doing too much with that. Wouldn't mind to see that increase. And the return on capital employed 2020 was 19 and went up to 20.37, 2021, and 2022, 21.81. And I'm expecting 2023 to be an increase, and it's just going to be trending right back in the right upward direction. So again, the average of companies is around 9 to 10% for their return on capital, and this company is above 20%. So yeah, I like it. And yeah, those are 3 dividend stonks that you can buy and hold forever. As always, do your own research before buying anything. Make sure to hit that like and subscribe button for more. And until next time, see yous.